I just recorded a 20-minute video. So for everybody's sanity, I'm gonna re-record here. Uh, the market is up, pretty nice, actually very nice. I go back to that quote. Mama said there'd be days like this. Don't copyright strike me because I didn't sing it. But when I think of that, when I think of that quote, I think of good days because most days are just a grind. Days like this are absolutely phenomenal. It looks like the Fed is going to hold rates. Treasuries dropped because people started selling them because the rates aren't going to go back up. On the labor front, we have payrolls coming back less than expected, which is a good thing. I have a video on that. And we have some very nice earnings. We have PLTR. I'm a huge fan of PLTR. I made a video about that. They were up huge. I think at one point over 20%. And I was one day away from gonna buy back all my calls. One down day away from buying back all my calls, and here was the start of it right here. I have some more calls down here, but I put in some limit orders. Doesn't look like they're gonna trigger. Palantir was at the top of my list to start, buying back those calls. I want to say I have about 1,000 shares of Palantir. So today is a very good day for me. Just not trading, but just buying and holding. Um, yeah, so phenomenal. Enjoy today. Look at those balances. It's a nice day out there. Now, here's where I did my 20-minute video. So, go back to here, go back to our financial industry. Let's talk a little bit more. Let's do part 2. Now, I covered this in part 1, but I had some questions, so I want to go back into it. So here, again, your advisors, this is going to be who your retail investors are going to be talking to. Okay, these guys are the ones that are diagnose stuff. So they're like your family doctor. So when something's wrong, your family doctor is not doing surgery. They're not doing all this stuff. What they're gonna do is they're gonna talk to you. They're gonna get a plan together. They're gonna hire some specialists. They're gonna you know order some tests, stuff like that. That's what these guys do. They don't get their hands dirty. They're just like the managers. They're the ones that are just managing your portfolio, getting some feedback from you, and doing a little bit of trading here or there, putting together a plan, maybe a little plan, not a huge plan, but a little plan. Um, and then these guys are the ones that do the dirty work. These are the specialists. If you want a mutual fund that's going into energy, they're the ones that are deep into the energy sector. Or if you want an ETF that does muni bonds, these guys are the deep into the muni bonds. Okay, so that's a little bit about what the relationship that these two have. Let's do a little bit more on that relationship. How do these guys get paid? It's incredibly important to know how these guys are getting paid. Okay, if they're internal, which means they don't talk to retail investors, these brokers and traders work for people. They work for investment banks, they work for little firms, stuff like that. They have a salary to keep their benefits up, to keep them, employed. Big training programs, long training programs. This helps as well keep some good guys on. Commission. A lot of these guys make hundreds of thousands of dollars in commission because they're excellent traders and they follow the rules of the firm and they make the firm a lot of money. So these guys are on salary commission. These traders, they know their stuff. Okay, this is who you kind of want to model after. So you want to know the trades, know the setups, be able to look at the charts. That's these traders right here. Hedge fund managers, you kind of don't want to be a hedge fund manager. It's like being a celebrity. Okay, these guys get a percentage of the profits. So if you are like in the know, you know a lot of powerful, important people, you know a lot of NFL players, a lot of billionaires, stuff like that, then you may want to become a hedge fund manager, right? Because that's your in. That's how you get the assets. That's how you get paid. Let's say they love you and they like your ideas. That's how you become a hedge fund manager. You're already a celebrity. You're already like in that life. Then you become a hedge fund manager. You take their money and you manage it. And it's off. It's kind of off the books. You have to report some stuff, but there's not a lot of regulation. Why? Because these guys voluntarily give you your assets. They make you a hedge fund manager, right? So that's kind of a little hedge fund manager information. They're kind of off the books. They're kind of in the shadows. They have one or two big clients. They may manage Saudi money. They may manage money for a couple NFL players. Whatever. That's a hedge fund manager. CFAs, those are the big dogs. Those are the pros. Okay? Those guys manage billions of dollars. They get a percentage of the assets. That's why they're managing billions of dollars. That's why they don't have 1, 2, 3, 4, 5 funds, each with $10 billion, because they want the $100 billion funds. They want that notoriety. They don't want all the paperwork. These are pension funds and mutual funds. These are typically huge, highly regulated. The SEC regulates them. They have to have all this paperwork. They have to have all this literature. They have to constantly be sending out what their top holdings are, if they're raising their fees, stuff like that. And this is all to external clients. You could go directly to mutual funds and buy them. T. Rowe Price, American funds. Go directly to them. You could buy them. Okay? But that percentage of assets, 12B1 fees, if you look on your prospectus, you'll see 12B1 fees. That's an advertisement fee. So T. Rowe Price, they have commercials. Other places like Prudential, they may have seminars, stuff like that. That's all advertisement fees. You know what their biggest advertisement fee is? Their advisors and brokers. If they can convince the advisors and brokers, the people that see the mom and pop, that see the clients, they can convince them to go with their mutual funds. They get the advertisement fees. They don't need commercials. They give it to their brokers. So you're going to pay this fee regardless. If you have a broker, it's going to your broker. Okay? That's just how it works. You're not paying your broker. The mutual fund is paying your broker. Advertisement fees, because they have them in their pocket. Now, if you're a good advisor, you won't have just one mutual fund company. You'll have 10. You'll have 15. All that is the best of what they do. No mutual fund company is the best at everything. It's impossible. So you may have Fidelity for this fund, bonds, or you may have American funds for, your overseas stuff. And they all have advertisement budgets, and the brokers get a piece of it if they have clients that are in those funds. Okay? So you're not paying the brokers. What you are paying, you're paying the financial planners. You're paying them a fee. They're not managing your money. They're just planning. They're saying, you do this, you do that, you do this. Here's what your plan is going to be. I need $500 for this plan. It's like a one-time thing. You do it yourself. Okay? So this is how they get paid. Now, I'm already at 8.5 minutes. Next week, or next time I do this fund, or this, the financial industry, part 3 is going to be some famous people that we're going to look and see if they're actually in the industry and what their career looks like. So we're going to do that on part 3, but that is part 2.